Hello, everyone, and welcome to the third and final installment of the Alliance Advisors and the Cape Town Stock Exchange's ESG webinar series. So far, in this three-part series, we've examined the E and the S in ESG from a United States and South African perspective in order to identify similarities and differences. Today's webinar is going to focus on the third component, the G in ESG, which is governance. So I thought I would start by kind of setting the stage for today's conversation. With a heightened focus on ESG and many stakeholders particularly interested in the E and the S components, the G can oftentimes feel like it is getting lost in the shuffle. Its importance to corporate health, though, must not be overlooked because it is critical to managing risks and opportunities. The G also sets the backbone by which the E and the S operate, in that it sets the foundation for how the board oversees material risks and opportunities. As the compliance, regulatory, and investor expectations on corporate behavior intensify, having sound governance practices is essential to company success. Let's start by providing a definition of what we're going to be talking about today. Let's define what we're talking about when we're talking about corporate governance. So corporate governance is the system of rules, practices, and processes by which companies are governed. It describes the standards companies have created to ensure ethical behavior. It addresses how boards of directors oversee company management. Corporate governance balances different interests among the different corporate stakeholders, whether that's shareholders, employees, customers, suppliers, or the larger community. The board of directors has the primary influence over a company's corporate governance structure. Poor corporate governance can lead stakeholders to question company operations and ultimately its investability. Good corporate governance, on the other hand, can increase investor and stakeholder trust, which in turn can promote financial success. So with this as a backdrop, it's clear to understand why communicating a company's corporate governance practices is important to a company's investor relations strategy. And today, our panel is going to delve into some of the chief governance issues from a US and South African perspective. So Marissa, if you could just go to the next slide, please. So this is what you should be seeing kind of on your screen now. And this will help you submit questions. If you have any questions, just go to the control panel, insert your questions. If you're having audio issues, you can go to the audio panel and switch your settings. So this is how you can participate in today's event. Like I said, just go through that audio and or question pane in order to fix any issues you may have with your audio or to submit questions you have for us. There are also some handouts that you'll see in the handout section. Please feel free to download those and review them at your leisure. They provide an overview of some of the key investor policy changes on corporate governance and other practices for the 2022 proxy season, as well as some of the advisory firms' updated practices and policies for the 22 season. So before we jump into today's discussion, let's provide a brief introduction to the different panelists. I will start by introducing myself. And Marissa, you can just flip to the next slide. Thank you so much. So my name is Brian Valerio. For those of you who have been on the previous panels, you probably know that by now. I'm an SVP at the Alliance Advisors Governance Practice, the advisory group in Alliance Advisors. And what I do is I work with corporate executives, board members, and their advisors on various corporate governance, proxy solicitation, shareholder engagement, and environmental and social issues. So that's my role, and that's the perspective that I will be providing for today's conversation. On the US side, I'm joined by Stephen Haas. Stephen, can you please provide the audience with a brief introduction of kind of your role and responsibilities?
Sure, thanks, Brian. I'm Steve Haas. I'm a partner at the US-based law firm of Houghton Andrews Kurth. I've got offices in Washington, D.C. and Richmond, Virginia. I'm co-head of the M&A practice, but also spend a significant portion of my time working on corporate governance matters. I'm licensed in Delaware, and as probably many attendees know, Delaware is a predominant jurisdiction for U.S. publicly traded companies. I am also the chair-elect of the American Bar Association's Corporate Laws Committee, which is charged with drafting the Model Business Corporation Act, which is followed by about a majority of the states in the United States. And interestingly, nice tie-in, that committee actually consulted with South Africa many, many years ago when there were revisions being made, I guess, to the Companies Act to at least consider some US influences. I think it's predominantly UK based, but our committee worked on that project. So that's a brief overview of myself. I'm very happy to be here.
Hi everyone, Eugene Boyson, CEO of the Cape Town Stock Exchange, and I've also been involved in the environment side and been involved on the social side, and third time's the charm now on the G for governance. Looking forward to today's discussion. I think when it comes to the external environment, there have been some big shifts in the underlying narratives for boards. I think we've shifted from financial capitalism to conscious or inclusive capitalism, short-term to sustainable, and now we're looking at from siloed reporting to integrated reporting. I think the imperative for boards around the governance components has only increased with the amount of stakeholder activism across funders, investors, consumers. We have to shift that into a stakeholder inclusive environment, and I think the Gene governance does that. Thanks. Go over to David.
Good afternoon, good morning everybody, wherever you have dialed in from. Brian, firstly, sorry if I gave you a minor heart attack there as my video went off. I just had to go close the curtain. It's so hot here in the city of Cape Town that I had the window open and then the curtain was flapping and my light was all over the show. So my camera did turn off for a second there. I do apologize. As per my bio that you see there below, my title has actually changed in the last couple of weeks since we initiated the conversation on this webinar. I've moved away from purely investments to looking at responsible investments. I'm now heading up responsible investment at Ned Group Investments. Maybe someone mentioned it earlier, maybe governance is not the sexiest of the ESG acronym, but it is the backbone of both social and environmental as well, and hopefully that comes out during our discussion today. And very humbled and excited to be here. Thank you.
Well, we're thrilled to have you. We're glad that any audio or visual issues were able to get resolved quickly so we can have your perspective on today's discussion. So let's go to the next slide, Marissa. And at this point, I'd like to provide an overview of some of the most important G considerations from my perspective on the US side. So let's jump right into it. Corporate governance is critical to issuers because it can promote effective, reasonable management that can deliver long-term success. Poor corporate governance, however, can cause a company to fail to achieve its goals, or worse yet, lead to significant financial losses. There are some prominent examples that you guys all probably know of some corporate governance failures. Most notably, probably Enron and Volkswagen in recent years. So the Enron scandal resulted in some significant, profound economic loss, with the price of Enron shares dropping from around $90 a share at its peak to around 26 cents per share when it was entering bankruptcy. There was also some significant financial loss for VW. There's some reports out there that as of June 1st of 2020, the VW emissions scandal cost the company about $30 billion in fines, penalties, settlements, buybacks. So you can see the stakes are large for failing to have the appropriate corporate governance measures put in place. So with that as a backdrop, it's easy to understand why stakeholders place such a premium on companies having good corporate governance. It's the foundation that enables companies to execute on their sustainability goals. So there is some tie-in with the environmental and social. All three of these components tie in quite nicely because many believe that in the absence of robust corporate governance, there's difficulty in companies being able to meet their environmental and social goals. So one of the central tenets of corporate governance is board quality and effectiveness, because this leads to quality leadership and ultimately is tied to company performance. Board composition, diversity, and accountability are also top of mind for institutional investors and issuers alike. Direct shareholder engagement is something that we will touch on today, and this is increasingly including an independent board member, and this is viewed as a critical component of good corporate governance because it provides direct feedback from shareholders to the company on the company's practices and policies, and that level of receptiveness and responsiveness to shareholder feedback is viewed as an important component of having a good corporate governance and good corporate hygiene. So as I mentioned, you get the E, the S, and the G, and they can all intersect at points. And one way where they intersect is through the oversight duties, because shareholders want to understand how companies have integrated material sustainability risks and opportunities into company planning. One of the final components that we'll touch on today is executive compensation, and how executive compensation structure is another important corporate governance consideration for issuers as they seek to tie compensation to performance, which ultimately aligns executive and shareholder interests. So these are some of the key points that we'll talk about during today's discussion. Marissa, if you could flip to the next slide, and Stephen, if you could just delve a little deeper into some of the key points that you are finding on the US side, I'd really appreciate it.
Great, thanks, Brian. I will do so. So you said at the outset, and it's interesting to me, that G is often lost in the shuffle. And I really think that's right. And you have to wonder why. And is it because we've gotten to such a great place over the past 20 years that companies are actually well governed? Or is it because there's so many voices and stakeholders in ESG that maybe it's not getting the focus? And it is indisputable, I think, that you've got voices in these debates who may be focused on the E and the S, but not the G, because they're not large investors. A large investor should absolutely be focused on the G as much as the E and the S. But that may be a reason too. I don't have an answer to that question, but it's a really smart observation that you make. Maybe just sort of quickly setting the table, in terms of what are the sources of governance in the United States. There's at least four that we're looking at. I mean, one, you've got stock exchange listing rules that impose requirements. A majority of the board has to be independent. There's independence definitions. There's a few disclosure requirements. Two, you've got federal securities laws, and the Securities and Exchange Commission, the SEC, has rules typically focused on disclosure, but there are some more substantive rules that sort of impose corporate governance requirements. But the disclosure rules themselves also tend to shape or even force corporate governance practices, right? Because if you are forced to disclose something and you don't really want to disclose it, then you may change your practices. Third, you've got state law. State law continues to be incredibly important in the United States, and for us, that's predominantly Delaware law, though not exclusively. And then finally, the non-legal influence for corporate governance it comes down to investors and proxy advisory firms in the voice that they have and the expectation that they have. So, I thought what I'd do is sort of walk through a bunch of, so-called, best practices or trends. And, the other panel should feel free to interrupt me, ask questions if they have any questions here about what I'm saying. So do you guys see that message on the screen? Okay, I just want to make sure that wasn't my battery. Okay. So, maybe kicking it off, talking about the board, because obviously, when you're talking about governance, you're obviously going to start with the board. And the chairman-CEO relationship continues to be an interesting one in the United States. And right now, it is still the predominant practice that the CEO is also the chairman of the board. And last year, if you look at the S&P 500 index, 37% of the companies had an independent chairman. That's an uptick over the years, but probably not as high as some people would think. There are a small handful of companies, probably around 20%, where you've got an executive chair, which typically is the former CEO who still hasn't completely separated from the company. But it's still the minority of companies that have split that position. If you've got that split, though, then investors expect that you've got a lead independent director with, specified duties, and that's going to include, sort of formal ability to call board meetings, to call meetings of the independent directors. It's a right to review and consult and provide input on the agenda and to review board packets that go out, and to serve as a liaison between management and the CEO, but also to be there to respond to investors on appropriate topics. But I think investors, there's certainly an expected sort of criteria or set of duties or responsibilities for a lead independent director that should be set forth in corporate governance guidelines if you're not going to split that role between the CEO and the chairman. Next, in terms of board composition, who are we electing? There's been a significant movement over the years, and I would be interested in knowing what the South African approach is, but in the US, most boards are elected annually now. It used to be you saw a lot of staggered boards where 1/3 of the board was elected each year, so you had 3-year terms. The predominant approach now is annually elected directors, and also directors are elected by a majority of the voting standard, on a majority voting standard. Historically, we used a plurality voting standard, and essentially that meant if there was not if it wasn't a contested election, then a director standing for election would be elected if one vote was cast in his or her favor. So most companies now have moved towards a majority voting standard that even if it's not a contested election, where you have more nominees standing for election than there are available directorships, it's still a majority voting standard. And if that director doesn't receive a majority support cast, he or she is supposed to tender their resignation for the board to consider. The other focus, I guess, on the board is really just shifting to who's on the board. There's been a significant focus, as probably everyone in listening to this program would know, on board diversity. And that's also tied into disclosure. So we're seeing it in terms of who is going on to boards. It is a significant focus in director recruitment practices, but we're also seeing interesting disclosure approaches. And we're seeing matrices provided in proxy statements that are breaking down the board's diversity. And that's actually required now by NASDAQ rules. You're required to include a matrix setting forth the board's gender and racial diversity. And we're seeing a lot of New York Stock Exchange companies include that as well, even though technically it's only a NASDAQ disclosure requirement. We're also seeing matrices on board response or board skills and experience, right? Because I think while there is a significant focus on gender and racial diversity on the board and making sure you've got appropriate viewpoints and backgrounds, it's not lost on investors that you also want the right mix of business experience. So we often see a matrix that would identify, government backgrounds, technology, human resources, human capital, whatever your preferred term is, that really sets it out, I think, in a very easy to consume visual format for investors, rather than them having to comb through backgrounds and long biographies. We continue to look at the issue of what is sort of charitably called board refreshment or board tenure. And the concern here is, how long have your directors been on the board? And if they've been on the board for too long, do they become complacent, right? Do they have tunnel vision? Are they open-minded? In the US, term limits are still incredibly rare. I'm guessing a little bit. I think I saw a study is somewhere around maybe 5% of companies have term limits. But mandatory retirement ages do tend to be fairly common. And about 70% of S&P 500 companies last year had a mandatory retirement age. Of those, however, the age was 75 or older at half of those companies with mandatory retirement policies. I think more generally, whether you've got a term limit, whether you've got a mandatory retirement age, there's clearly a very strong focus right now on board refreshment and tenure. And it creates some challenges for companies. This is an area where, one thing I like about governance is, in an ideal world, it's not a one-size-fits-all approach. Of course, that is the criticism that you hear from a lot of companies, that that's largely where we find ourselves. But to me, governance, ought to be finding the right approach for that particular company. And you do often see situations where you have a long tenured director who may be the best member of the board. And I've seen situations where a director who's been on the board longer than the CEO has been at the company, that gives that director, that tends to give them a lot of clout and influence on the board, rather than a director who's been serving alongside a CEO for, say, 10 to 15 years. So, those are the kind of things we're thinking about in looking at board tenure and how do you move directors off and try to refresh that board with new views. I think the acceleration of, technology and innovation in the past couple of years has really put an emphasis on this, with boards needing to bring on new skills at the director level to really keep up with industry changes. And I think that has actually helped the discussion that goes on in nominating and corporate governance committees. Outside of board composition, a hot issue recently has been oversight of risk. And, I mean, that's obviously not a new issue, right? And certainly if you go back to the failure of Enron, I think that was a giant wake-up call for the United States in corporate governance. But there's sort of been some new life breathed into this area recently. Lawyers refer to this as the duty of oversight, sometimes called Caremark duties after a famous case that was in Delaware. But essentially, your legal duties as a director are to ensure that you've got a reasonable system of internal controls and procedures in place, and that you can't ignore red flags of misconduct. If you've been put on notice that there may be misconduct, a director has a duty to investigate. And traditionally, those are viewed as some of the hardest claims that you could possibly bring in corporate law in the United States to hold a director accountable. However, we've had two recent decisions that refused to dismiss claims against directors. One involved an ice cream company where there was a listeria outbreak and consumers died. And the other was at Boeing, involving the crashes of the 737 MAX airliners. So, I think those are both fairly extraordinary situations where you have people dying. But the point has been well taken, I think, by a lot of boards, that if you look at these court opinions, they focused on what the judges called mission critical risks. And you've got to have a process in place that shows, that demonstrates how boards are overseeing these mission critical risks. And in both those cases, one of the key problems was there was no record that the board was getting interim updates or reports on these fundamental issues that you knew. I mean, if you're in the food business and consumers die, it's mission critical. And there was no history in that particular case of the board being updated on FDA compliance or being made aware of FDA citations in the company's production facilities. So that continues to be a pretty big issue for us. Last issue with directors, and I want to talk a little bit about shareholder proposals. We do have a concern about what we call overboarding. And I don't know how hot of a topic this is in South Africa, but there is increasing concern from shareholders that directors are overextending themselves and serving on too many boards, and therefore don't have the necessary time to put into their directors' duties. And this is largely now being driven by proxy advisory firm policies as well as investor policies. And today, ISS, Institutional Shareholder Services, policy is that an independent director should not sit on more than 5 boards, and that a CEO should not sit on more than 2 outside boards, plus the board of his or her company where they're currently serving as CEO. Glass Lewis's policy is slightly more restrictive. It says the CEO should only serve on 1 outside board. And there's investors that have got different policies on this, and some of those policies are more restrictive, certainly with respect to ISS's policy. So I think the concern of overboarding can be a valid one. I think there's been some directors who've probably been embarrassed when it came to like how many boards they sat on, especially when you start thinking about some nonprofit boards that actually do not get picked up in these policies, but can also be quite time consuming. So that continues to be a big issue. Next, I want to talk a little bit about shareholder proposals, because one thing that makes the United States unique from some jurisdictions is the voice that some shareholders get in terms of putting proposals related to environmental, social, and governance topics on the company's proxy statement for all shareholders to vote on. And we have an SEC rule here called 14A8 that currently allows, it actually changes this year, but historically it's allowed any shareholder who's held $2,000 worth of stock for 1 year to submit a proposal, and it's included in the company's proxy statement. And these proposals have generally been pushed forward by a very small group of people. 10 proponents accounted for more than 2/3 of the proposals submitted at S&P 1,500 companies during the first half of 2021. So it's a very small group of people pushing a lot of proposals. Last year, interestingly, the most common proposals were actually in the social area. That was the first time ever. But governance continues to be an active area we saw 277 governance proposals submitted to public companies last year during the first half of 2021. And if you think that sounds like a high number, that was a decline from 328 in 2020. So this is a really popular area for governance proposals. Of those, 199 of the 277 actually went to a vote. They averaged about 40% support, and only 36% passed. I'm sorry, 36 proposals passed, but I think you really have to focus on the fact that they got 40% support. So are they being passed? No, not usually, but can you ignore 40% of your shareholders? Potentially at your peril. Most of these proposals in the governance world focus on takeover defenses and the dismantling of them. This is giving shareholders the ability to act by written consent, giving shareholders the ability to call special meetings, and dismantling other takeover defenses such as supermajority voting requirements that are often viewed by some shareholders as anti-democratic, getting rid of staggered boards and converting to annually elected boards of directors, and eliminating dual class stock structures. My personal view here is there's a little bit of a fetishization of takeover defenses. You still don't see a whole lot of hostile takeovers in the United States. They continue to be fairly hard to do. The law is fairly deferential to boards of directors. It often becomes more of a PR and IR battle than a legal sort of tactical battle of taking control of the company. But I think the activists would tell you that by dismantling these takeover defenses, even though they may not be significantly increasing the likelihood of a hostile takeover, they are increasing management's accountability, that you've made them more vulnerable to somebody coming along and conducting a consent solicitation to remove the board and take over the company. And I think there's validity to that. We do see some proposals on independent chairs, which I talked about earlier. There were 38 proposals to separate the CEO and chairman role last year that averaged about 32% support. So, I think that actually shows, and I don't think any of those proposals passed last year, by the way. I think it shows that investors on this particular topic in the United States are still pretty open to considering who is the CEO, who is the chairman, and not sort of instinctively going to a knee-jerk reaction that, well, of course, we ought to always separate that proposal. I think companies, by and large, are pretty successful in articulating why they've combined the role of the chairman and CEO, combined with a powerful lead independent director. Where you've seen these proposals pass, there tends to have been some sort of a pretty significant governance failure that occurred at that company in the year or two leading up to it. Last couple things, and I'll turn it over to David. We've really seen an onslaught in the past couple of years of investors coming up with their own voting policies. And this is a good thing and a maybe not so good thing, depending on one's perspective. There has been an immense amount of criticism, a lot of it fair, leveled at institutional investors over the years for blindly, for lack of a better word, following the voting recommendations of proxy advisory firms. To be fair to the investors, the response was typically that we do not have the staff available to analyze all these proposals and come up with our own independent decisions. As you all know, institutional investors often have thousands of companies within their portfolios. The stewardship or governance group was often viewed as overhead, and institutional investors trying to minimize their cost, and they really just could not dedicate the necessary resources to reviewing shareholder proposals and engaging with portfolio companies. And I think to the credit of many institutional investors, they have really increased the staffing. And they've listened to this criticism about whether they're sort of blindly outsourcing their vote to proxy advisory firms. So many have come up with their own voting policies. They're almost all of them are publicly available. I guess I just hesitate when I say it's a good thing, but maybe not a great thing. It provides certainty in terms of you generally can look up to see how your investors are going to vote on something, but they don't, these policies are not identical. So you can have some very large investors with different policies. So maybe companies should be careful what they wish for, right? last thought, I guess, Brian, you asked me to mention executive compensation, and I think this is sort of an interesting area of ESG metrics and executive comp. So historically, right, executive compensation was generally tied to total shareholder return, and it was trying to get the long-term incentive and the short-term incentive compensation correctly balanced, but almost exclusively tied to shareholder return. And if you saw an ESG type of metric, usually it was in safety, and that was sort of an obvious tie-in, right to shareholder value. That's changed a lot in recent years, and we're seeing a lot of different ESG metrics tied into compensation. I think the interesting question that we don't know the answer to is how this holds up during an economic downturn, right? And will executives be criticized for large pay packages if they've done exceedingly well in reaching diversity goals or reducing the company's carbon footprint, but the stock price is down 10%? Because we've had a great market over the past couple of years, and I think that makes it much easier for management teams to focus on ESG. Investors certainly say the right things about ESG, that this is about sustainability, it's about long-term shareholder value, but what we don't know is if that's going to hold up during an economic downturn where there's going to be much more pressure from investors as opposed to maybe other stakeholders on financial performance in the near term. So I think the jury is out on that, but there has been, I think, a sea change and seeing ESG metrics tied into executive comp. So I'll stop there. Happy to answer any questions or otherwise turn it over to David.
I just have a couple of points, if I can just chime in quickly. So you talked about the board skills matrix, and one, I think, policy shift that's important for people to be aware of is this year Glass Lewis may start recommending against the chair of the nominating and governance committee at companies if they determine that the disclosure of those skills in the board skills matrix is insufficient. So that's something that you can see as being a shift this year, and really shows the importance that institutional investors who are Glass Lewis's clients are really placing on this type of disclosure that caused them to create such a strict policy on it. And you also mentioned the overboarding policies, and you talked about ISS as well as Glass Lewis's policies. And I'm finding that a lot of the institutional investors, particularly some of the large passive funds, have even stricter policies than what's outlined by ISS. So a company should really be aware of some of those policies as well. And I'll just give you overall where we're coalescing around. It seems to be 2 max boards for a CEO and then 4 max boards for a non-CEO. So that's important for companies to understand. You could definitely fall within like the ISS acceptable range, if you will, but still run into significant opposition if you have a director who falls outside of that 2 and 4 classification. So just something to be wary of as you head into the proxy voting. You're going to want to look beyond necessarily ISS's policy on this particular issue, because it really is a little bit more, no, not a little bit, it's more lenient than what some of the other policies are. And about the Say on Pay, just another point on Say on Pay, there was significant opposition to Say on Pay last year, which is going to lead to some interesting votes on Say on Pay this year. Because when you fall below certain thresholds, it's 80% of votes cast for Glass Lewis's threshold, 70% of votes cast for ISS's threshold. When your Say on Pay vote, when a company's Say on Pay vote receives less than those thresholds, the advisory firms and a lot of institutional investors will expect companies to do proactive engagement to show their responsiveness to the shareholder feedback. So it's going to be incumbent upon companies to have gone ahead in the off season, directly engaged with their shareholders to understand the rationale behind some of the against voting, and then come up with a plan to offset that and to mitigate those concerns for shareholders, and then go ahead and clearly disclose the changes that they have made in response to the shareholder feedback, so that they can show the advisory firms and the institutional investors that they are listening, they are receptive to the feedback. This is part of the overall corporate governance structure that we're talking about, where there is the engagement and the direct dialogue between shareholders and issuers, so that they can ensure they're serving shareholder interests. So something to keep an eye on for this year. And you mentioned the independent chair proposals, and you mentioned how they generally don't pass, but the 40% threshold, that is the type of support that I agree with you. It does trigger consideration for companies to respond appropriately to shareholder feedback. And you mentioned the importance of having the robust duties and responsibilities for the lead independent director for those companies, which is some of the reasons why those proposals ultimately don't pass. So some really great stuff. Thank you for that. I won't take any more time, David, excuse me. I will hand it off to you.
Thank you very much, gentlemen. Does somebody need to go to the next slide for South Africa? Fantastic. So I'm going to talk kind of briefly through all those points that you see in front of you, and then Brian, I know as a mediator, you're absolutely going to love this, but I'm going to offer a disagreement of opinion. I think, or at least with governance here in South Africa, I think it's still at the forefront of a lot of people's thinking, and there's probably a number of factors for that. Fingers being burnt in recent history because of governance failures. We also find that governance is quite easy to put a blueprint lens over, and it's not as open to as much subjectivity. If we think about an equity analyst looking at a company, they can go through governance best practices, and we have a very good blueprint check of the King Codes and corporate governance in South Africa. In terms of some of the resolutions, we've had very few climate-style resolutions in South Africa. I think I can think of maybe 2 or 3, 2 with the banks and 1 with our biggest emitter. But the majority of kickback from shareholders when it comes to voting is typically on the re-election of directors and remuneration policies. And then last but not least, we found that working with some smaller boutique asset managers who might not have the full capacity to look at ES and G, they go back to that argument which you said at the beginning, Brian, about governance having being the backbone of an organization. So if a small boutique is quite stretched in terms of capacity, they'll focus quite a lot on governance, which gives them a degree of comfort that the environment and the social may be well managed. But of course, that's an oversimplification of things. So my first point there around South Africa through an ESG lens, it's quite funny to talk about a country along ESG lines. I do beg your pardon, I didn't manage to watch your webinar on environmental and social. I think I just managed to get through the first quarter on social before today. But South Africa, for the Americans that have dialed in, have one of the biggest, if not the biggest, Gini coefficient in the world. So we have the highest rate of inequality of any country in the world. And COVID has obviously exacerbated as well the gender inequality from an earnings potential and economic participation potential here in South Africa. On the environmental side, and we're also one of the 30th driest countries in the world. So some of my South African colleagues and friends don't even know that. We are incredibly water insecure. We're having desertification happening here, probably like you might be having in California on the west there in the US. But we also try to draw some of these conclusions because obviously the environmental and the social aren't mutually exclusive. So the drier weather obviously affects agriculture, food production, crop prices, and then that hits the wallets of the most vulnerable. Going back to the governance, so there's a prevailing view here, which I mentioned about governance being the backbone of an organization. And we run an annual review on 47 fund managers, split roughly in the middle. So some 50% South African and the other 50% global. We have Australian, UK, and a couple of US asset managers participating in this review. And we found, I don't know if anyone's familiar with the principles for responsible investing. Principle 1 speaks about the integration of ESG into an investment decision-making process. And we found that governance, almost all the managers say that governance is integrated in the process. It is a meaningful informer of whether they invest or sell out of a stock, whereas social and governance were more about it has a fair amount of influence on whether they buy or sell into a company. So not as strong as the governance side. And maybe that speaks a little bit to the opaqueness of social and environmental at times. So typically in South Africa, the world used to look into SA equities, and we carried what was called a governance premium. So we had quite strong governance historically here in South Africa in terms of the private sector. We had strong institutional oversight, and maybe recent history, we've lost that governance premium. So where people aren't willing to pay up because our strong governance has always been let down by a handful of poor examples in the last 5 years. And I'll try to touch on some of those sort of superficially in a moment's time. Another interesting thing that I did wanted to bring up, and I was looking at some academic research around this, is how national government are behaving. So if the public sector has low or high levels of transparency, are they trusted by their constituents and the population? How deeply is corruption entrenched? And how this can go and influence the private sector. So if corruption is quite a big issue here in South Africa, and when we do a deep dive into the companies and their board members, are there any political, what's the word I'm trying to think of? Is anyone politically compromised? That becomes quite a concern here in South Africa. So because you might have structurally high corruption in your national government, how does that feed through down to the private sector? I mean, how does the private sector behave? So if you're in a country where there's a lot of corruption, your taxes aren't being well spent, you might take the route of trying to dodge and pay as least amount of tax as possible. But it also sets an example at the top there in terms of what is ethical leadership, and does that therefore feed down to how corporates in the private sector may behave? And research suggests that there is a correlation there, and I hope that's not a reason for South Africa losing its governance premium over the course of the last few years. I'd be curious to hear the US perspective as your administration changes, if that affects the way that corporates can behave. In terms of anecdotally, I guess I'd like to tell a few stories that drive home some of these points. When we met yesterday, I mentioned a South African telecoms company called MTN. I mean, at the turn of the century, they aggressively grew their business into rest of Africa. And I think this talks to the nuance of emerging markets investing, which might be a little bit different or not as well understood by those that have dialed in from North America. So MTN started branching out into the likes of Afghanistan, Iran, Rwanda, Congo, Brazzaville, Sudan, Syria, Yemen, so politically quite volatile regions. We would have thought maybe some of those in the Middle East, they would have learned quite a strong lesson, but it turned out to be Nigeria in about 2015-16, if my memory serves me correctly, where the government clamped down quite aggressively in terms of them expatriating some of the profits from their business, and they've now had to ring fence that business. And the response from MTN is just to strengthen their own governance structures internally, as well as how their relations with the public sector. So there's a lesson kind of learned there from MTN, and I think they even had a change of leadership as a result of that as well, which kind of also brings an interesting question around social responsibility. So if you're a telecoms operator operating in those volatile areas, I mentioned Syria, Liberia, that Jasmine revolution that took place in North Africa was also accountable to heightened communication between individuals and getting critical mass momentum, people arguing for certain freedoms, which wouldn't have taken place if the telecom wasn't operating in that country. So it's a kind of an interesting balance that they've had to try strike in some of the regions that they operate in. So in terms of the work that we're doing, we try to focus on materiality. I think with environmental and social, particularly environmental, you get so many metrics to look at. And Stephen mentioned even a CEO being incentivized around emissions. I think he spoke about that balance of total shareholder return versus ESG linked remuneration criteria. I guess the same for climate change. During COVID lockdown, we found so many organizations lowered their CO2 footprint and kind of spoke like they're so proud you did that, and should the CEO be awarded for doing so. But it's also about striking that balance, I think, between the short, medium, and the long term. So something like climate change is obviously a long-term trend. So if you can set up a remuneration structure that looks at climate change and the capital that's been allocated to remediation and arbitration within the realms of the company, how might it look in 2025 and 2030? Because the work being done today might only have results further down the line. And it also speaks a little bit to clawbacks as well. So when for example, a CEO leaves and some of the work that they've done doesn't necessarily result, what clawback opportunities are available to them. So in terms of materiality, again, environmental, some of these service providers can spit out 120 environmental metrics that you need to look at. And I spoke about smaller asset managers here who just don't have the capacity to look at 120 environmental factors that focus on materiality, or maybe trying to keep things quite simple. So what we've adopted, and I can speak from our own internal experiences, we're looking at 4 things that are material to us, and it's climate change, biodiversity loss, people diversity and inclusion, and human and labor rights. So we're trying to keep it quite simple. What is material, and where can we kind of effect some sort of positive outcome through a sustainability or a sustainable development goal type lens. So what I have there on the slide there is within the realms of governance, where does materiality fall? So I mentioned earlier the King Codes and corporate governance here in South Africa. So there's a Dr. Mervyn King, and they've gone through a few iterations. I think we're at iteration number 4 now in terms of these codes, and they really do set quite a world-leading blueprint for corporate governance and what is required. So you spoke about tenure of directors, how long they're sitting on the board, when do they become compromised. The latest iteration of these codes allows for a little bit more of critical thinking, but historically they almost drew a line in the sand and said 9 years. If a director's been there for longer than 9 years, maybe they're compromised or their independence is compromised, and you start to question that. How much of their wealth is invested in the firm, and is it material in terms of their shareholding to them? Therefore, they might be compromised from their own independence and their own sort of sound mind when it comes to looking at the company as well. Again, I just want to talk very quickly about some of the complexities around that. So if we did apply best practice in terms of independence of the board. So here the requirements, I think, of your non-executive directors have to be majority independent. That's 50% plus, or it's encouraged that they're majority independent. But in our, in our interactions with fund managers and analysts, etc., yes, they do place a governance premium if there's strong governance in place, but also investors actually get some sort of comfort if it's a family-owned or a founder's mentality to that firm. And often when there is that case, we have, for example, a company called Glencore, where they have a very strong founder's mentality. Richemont is an example. We have the Rupert family involved in Richemont to have Johan Rupert is the chairman and, obviously an executive prior. So the independence might be lacking there in terms of a very strong individual. But as a shareholder, you know that he's also emotionally invested in the journey of this company, despite all the probably infringements against what is considered best governance practice. And that even gives shareholders a degree of comfort. So it's also trying to take it almost on a case-by-case basis. And I think that's what the latest iteration of the King Codes is trying to encourage shareholders to do, to apply a little bit more critical thinking. Another interesting anecdote, I guess, on Richemont, because the next line item there was around diversity and inclusion. This is becoming increasingly important for us. I think in South Africa, it takes on maybe a different level of conversation versus the US. We obviously have quite a checkered history and a checkered past, particularly along demographic and racial lines. So we have something called broad-based economic, Black economic empowerment in South Africa. It used to be called Black economic empowerment, and they found that there was a lot of criticism around the fine print behind that, and a few people really benefiting from that, and it wasn't broad-based. And they introduced the broad-based at a later stage to make sure there's a groundswell of, I guess, reallocation of wealth across the country and trying to squeeze that Gini coefficient, which is obviously completely skewed here in South Africa. And then on the topic of gender diversity, so I mentioned Richemont earlier. I think they had, if I go back 5 years, 1 female on the board out of a 16-member board. So 1 in 16, given in a company that operates in luxury and the retail space, doesn't hold water. In fact, it doesn't hold water for any company anymore to have such low representation. I think, if you look at some of the studies, and it's not unique to South Africa, but 80% of something like household decision-making is made by the lady of the house. So in a retail company, if you're not having gender diversification, you're going to be at a strategic disadvantage. Another thing we're starting to look at, which is still relatively nascent in South Africa, is cognitive diversity as well. Stephen touched a little bit on skill set. Skill set's been quite interesting. You have to, again, look at an organization on a case-by-case basis. I know coming from a bank, it's now around financial services, retail experience, cybersecurity is obviously becoming increasingly important. And I was going somewhere with this, and I've lost my train of thought a little bit there. But in terms of cognitive diversity, the studies also show that by having quite a diverse board, and that also speaks a little bit to demographic, is you actually get better strategic decision making. So there's an actual benefit to shareholders in having a diverse board, no longer what we say here, the old pale male kind of makeup of a board of yesteryear. So transformation in South Africa, I think I spoke a little bit about. I think people in South Africa are generally very empathetic to the drive to really get greater representation. Again, it's really about the implementation of that. But importantly, when you're looking at a board and its diversity, it's no longer about looking at the board of a company, but actually going a little bit below the surface and trying to see what is diversity, what inclusion is taking place at non-executive level. So if I use, I may get in trouble for this, Nedbank, our parent company, I think only have something very low female representation on the board. I think out of the big 4 banks in South Africa, we're the lowest. I think somewhere mid 25%, somewhere around there. But if you look at the executive committee who's making day-to-day strategic decision making of the company, it's as much as, I think, even north of 50% or a little bit more than 50%. So going beneath the skin of the company can offer a different insight in terms of the inclusion and sincerity that they're taking around that. I also want to give and I mentioned this at the beginning, just an example of some of the governance shortcomings we've had here in South Africa, and where shareholder value destruction has been quite material and is very front and fresh of mind here with investors and our clients in South Africa. And of course, hindsight is a wonderful thing. We can go back and do a post-mortem of certain companies and where those governance failures took place, but it also offers you the opportunity to go, okay, let's look at our current portfolio of companies and what can we learn from this past experience to attribute to our current portfolio, and maybe identify any governance risks within the companies that we do hold. So I can't remember if I mentioned earlier, a company called Steinhoff is probably, for those South Africans that have dialed in, the one that we are most familiar with. And I think that was around about 2017 when it really kicked off there, where in fact, the Americans might even be familiar with Steinhoff. I think their own mattress firm have had to undergo their own liquidation issues or going concern issues recently. But within Steinhoff, if we do a post-mortem, they had that kind of founders mentality. So a very well-known South African businessman, Mr. Christo Visa, was also the chairman as well. So he was a non-independent chairman, owned an incredible amount of wealth, the majority of his wealth in a company like this. Therefore, they had a lead independent director. So like Stephen mentioned, your next best step, if your chairman is non-independent, you have a lead independent director. And the gentleman at the time had been on the board, I think, for 13 plus years. So his independence was potentially compromised. He also had a substantial and material amount of wealth in shares in the company. Again, a red flag in terms of his independence. And overboarding. So overboarding is a major thing here in South Africa. You spoke about 2 and 4. I think he was sitting on maybe 4 or 5 other what would be considered kind of blue chip companies here in South Africa, top 40 size companies. So is he able to fulfill his fiduciary duty of providing sufficient oversight on 5 relatively large capitalization companies here in South Africa, along with his day job as well? And so the 2 and 4 conversation is interesting. I know when we hold shares in companies, we wouldn't like our CEO to sit on the board anyway. We want that CEO's focus to be purely on the company that we invested in. So maybe we more 1 in 4, if I can speak out of turn for the rest of South Africa. So also going on Steinhoff, and this also raises some interesting questions. And I know you guys had a chuckle when I mentioned this yesterday in our catch up around having a chartered accountant as your CEO. And I think a majority of CEOs probably are chartered accountants. And a close relationship with the CFO, but the CEO was a chartered accountant. The nature of the business, Steinhoff, was very acquisitive in the sense that they bought a lot of companies. It wasn't organic growth. And around that came a lot of opaque accounting and the ability to, for lack of a better word, cook the books. So this subsequently came out that he was controlling a lot of what was being fed to investors and analysts. And that was another governance shortfall. And I can't recall off the top of my head, but what this also engendered was deeper a reflection on the auditors. So we've had a lot of auditors, also their reputations been dragged through the mud here in South Africa. I can't remember all the names, but some of them quite on a political spectrum as well, what's happening at a national level. So typically your big is a big 4 or 5, your PwC, E&Y, and what we started to look at more closely is auditor rotation. One of the big companies here in South Africa has had the same auditor, I think, I'm not kidding, for almost 100 years, and it's one of the big 4 companies. And I think that sweet spot is around 7 years is what we look at from a rotation point of view, give or take on a case-by-case basis, of course. Going on, I think, probably to my last point, well, I guess I also wanted to maybe reflect a little bit on what's happening globally, and maybe the listeners would appreciate this more than talking about a South African company specifically. But again, hindsight is a wonderful thing. If you go back and look at BP, which was British Petroleum, I think it's beyond petroleum now, the Deepwater Horizon oil spill, if you look at their environmental discretions and fines and whatever leading into the Deepwater Horizon oil spill, you could see an uptick in the red flags showing up in all their different sites across the world. And maybe that was an indicator of a potential disaster, but I'm not sure if litigation is still ongoing in terms of accountability there. You mentioned VW or Volkswagen earlier. From what I recall from Volkswagen, also had numerous board members that had been on the board for a very long period of time and were supposedly independent, so they became quite comfortable in their role. And I realize I'm going on and time is coming very short here, but engagement is another touch point between South Africa and maybe US investors where it's quite different. So we don't have the luxury of 4,000 listed entities here. Instead, our universe is sometimes realistically only 100 companies that a fund manager can look at. So the luxury of divesting is not always on the table. If you want to hold a strategic oil or energy asset, there's a company called Sasol, and there's very few alternatives. So to sell is often not very pragmatic, despite it being a very poor environmental company, but rather stay invested and see how you can affect change through engagement. So engagement takes on quite a material role here in South Africa. And Naspers was another example. So they hold 30% in Tencent, which is the Chinese US tech company, but they have a dual share structure, which Stephen mentioned earlier, with A and B shares, and where one has more voting power than the other. So your shareholder who owns the economic interest, but not necessarily the voting interest, can't really affect change when it comes to voting at AGMs, and that's obviously ruffled a few feathers and raised governance concerns here in South Africa. And I've gone on way too long, so apologies, but I'll hand over back to you now. Thank you, Ryan.
Well, I'd rather give it back to Eugene, get your perspective on some of the points that David brought up and what you're seeing from an exchange perspective over in South Africa.
I think one of the big things that are slightly different in terms of in enforcing that underlying ESG component is the exchanges are the regulators for our public listed entities. So the exchange is regulated by the authorities, FSTA, the Prudential Authority, and the exchange in turn is the regulator of the public listed companies that are using the exchange as a vehicle for their listing. And our focal points in terms of how we enforce those components are, as David mentioned, along the lines of the Companies Act, the King IV governance principles. And then also, I think one thing that probably been the biggest driver of the underlying change for companies and public listed companies is over the last 3 years, a lot bigger progression in the Companies Act toward defining that underlying director's liability and what the responsibilities are, but also what the downsides are for directors, and all the way to the point of certain components suffering real criminal liability. And I think that's changed the dynamic and the behavior at the board level, not just around the disclosures, but also in understanding the underlying risks, driving the underlying risk appetite statement, understanding what those material risks are embedded within the company. I think the second big driver in there is not all companies who have public listed debt are necessarily public listed at an entity level. And I think what King's try to do is capture companies that sit outside of that public listed vehicle as well. So they've included supplements which looks not just towards public listed companies, but NGOs, state-owned enterprises, SMEs, and given a set of guidance principles that can guide them on decision-making and core decisions that have to be embedded within their organization. A big part of the exchange's responsibility in delegating down those underlying King responsibility is applying a proportionality to the companies. In other words, not all companies are massive. Some of them may only have 10 employees, but have $1 billion market capitalization. How do you get the right level of governance to a company that's small, and making sure that it's fit for size and purpose? So a lot of the art attached to the science of governance is around applying that underlying proportionality principle. And then just in terms of, you mentioned independence, I do want to re-emphasize this just in the SA context, because I think this is one place where it's pretty religiously followed, and it'd be very loath to find a public listed company in South Africa that doesn't have at least 4 independent directors, that doesn't have an independent director chairing the group audit and risk committee or the social and ethics committee. To the extent where there is a non-independent chairperson, there's invariably a lead independent director. And I can't think of one example where we have executive chairperson and CEO and the roles combined into one. Very unlikely that would happen. And that independence is pretty aggressively enforced, not just by the companies, but by the shareholders themselves in terms of re-election and what comes due for re-election. Often much is made of the corporate failures over the last few years, and I can think you mentioned Steinhoff, but there are others. I think it's too easy sometimes to point to governance as the underlying failing components, and we really do break it down. Invariably, there's some type of level of embedded fraud that sits behind it. And I've always said, in the old audit words, it's very hard to define a control for fraud, right? It doesn't happen. And too often we pull this government component into that space. So we tend to focus on those underlying principles and use that as the scorecard where we test the boards back, test the companies back that are going to undertake that public listing. And then what we do is, no one's ever going to fully comply with Companies Act or the underlying King principles. So rather what we want is a public disclosure of where you don't comply, right? When we understand where we don't comply, it's easy for external public, analysts, shareholders, etc., to act as that third line of defense to see where would be the cracks if you don't comply with certain components. And that public disclosure of non-compliance is often a very strong incentive for them to get themselves back into line, or at some point in time to reinforce or bring them back into space. So I'm going to leave it there and just say I'm with David in terms of, I think out of the three, governance is probably the one that's been taken the most seriously over the last 5 years. And I think it's not because of a governance failure, but because of a government failure in terms of corrupt practices over the last 5 years. And second to that is, I think we've seen a slight audit failure in terms of the large audit firms being complicit in some of these failures, as corrupt practices have perpetrated into what would have been that second line of defense for shareholders. So I think shareholders have now elevated governance and are using that as really their first line of defense and what their expectations that are around protecting their interests and protecting stakeholder interests. Thanks, Brian.
Great stuff from both of you. Thank you so much. It sounds like there's a lot of similarities, and there are some key differences. From my perspective, one thing that really resonated is very top of mind right now is you talked about administration changes and how it can impact regulations. And the SEC just this week proposed climate change disclosures. So not necessarily a G issue, more of an E issue, but it shows with the new Biden administration and the new SEC board that's put in place, what they are emphasizing now is different than what the previous administration under Trump had been emphasizing. So we're pretty much out of time, but I wanted to give it back to you, Stephen, see if you have any final thoughts, any concluding thoughts, and then we'll wrap it up for everyone.
Well, I mean, this has been fascinating. Clearly, there's more similarities than just our common language, right? But you know, what I would say, when I view corporate governance and the evolution, the 1990s were the rise of the independent director, and I think the early 2000s were probably the rise of the proxy advisory firms. But I think right now in the United States, we are in the era of the institutional investor. They have tremendous power and they now are using it. There is no reluctance to vote against management out of fear that they're going to get cut off from, the next management meeting. Boards, often one of the first questions a board asks is how are institutional investors going to respond to a particular matter that the board's going to have to vote on. So I think it gives them a tremendous amount of power, and because the institutional investors are so vocal right now on ESG, I think that's where the U.S. stays, and that's where it's going, is further embracing of all things E, S, and G. I still stand by what I said, cribbing off of Brian earlier, that in the U.S., I just don't think G is, it's the lesser of the three. And I do think that's because there's actually pretty good governance in the United States. And that sounds like that clearly is a difference with South Africa, where there's much more focus on governance. And I think there's probably a lot of different reasons for that. But I think all three of the letters stay in the forefront as long as the institutional investors continue to be so vocal about it.
Well, thank you all for your time today. I really appreciate all of your different perspectives. It was very enlightening for me. Definitely some great points that I will take back to my clients in the US, and also things that I'll keep an eye out for to see if some of the trends that we identified in South Africa make their way over to the United States. So thank you all for participating. Thank you to the audience for participating. If anybody has any questions, you have all of our emails. Marissa, if you just go to the next slide, everybody can take down the email addresses that we provided right there. So thank you, everyone. Hope to see you guys all again soon. Maybe next year we'll do another panel on some of the new developing trends. Time will tell. Thank you, guys. Bye.